So first of all, I want to welcome you guys to the October Advanced Class 2025 session. And before we start the classes, I want to let you guys know that we're all here to learn. And for you to register for this class, it means you need fine-tuning in how you already trade because it's not a beginner's class. And I would expect everyone here to act accordingly. Since the class is not for beginners, it was already stated before you join the classes. It's for advanced students that already have the basic knowledge of trading. So we're here to learn. Just because you have one session doesn't mean that you're already going to be profitable and know everything there is to know about this strategy. It's something that it's not even like complicated. It's just something that requires you being patient enough for the classes to be done, back testing, forward testing, practicing what you've been taught. Most people are here because they're expecting signals. I don't give signals. It was already stated, and some people will start sending you setups that are yet to play out because just because I've taught one topic does not mean that every criteria that needs to be met before you take a trade has been taught, because there's first topic, second topic, third topic, fourth topic, and all those things need to be in line before you take a trade. So because we are done with one topic doesn't mean that you already know what you need to know for you to jump onto the live market. So if you're not careful, you will burn yourself out. So I suggest learning at the same pace that I'm teaching. So it will be easier for you if you do that. So um that being said, let's start the class. So let me share my screen with you guys. So the strategy that I'm teaching all consists of three key things, well, four key things: market structure, liquidity, point of interest, and then directional bias. Market structure, liquidity, point of interest, directional bias. Now, for the question sessions for this class, once I'm teaching, you focus on learning. After we are done with the classes, a recorded session will be sent to you guys to practice what you were taught and watch the classes and everything. And then the next class we're going to have tomorrow, you can now come with the questions you have from this first class. So I would prefer you pay attention to the teachings first so that you can get everything that I'm saying. So don't miss any important notes. So first of all, the market structure basically tells you the direction of the market at that point. The liquidity is the zone where there is money in the market, where price is likely to go to first. And then the point of interest is what the key areas you look out for you to enter your trades. Then the directional bias is basically the general direction of the market on the higher time frames. Hope you guys are following me up, please. And is everything clear? My recording, is it clear? Can you guys see my screen very well? Okay, very good. So we're going to start off with market structures first. So market structure is basically the current flow of the market, the current direction of the market, the pattern prices to approach one point or one level in the market or another. So for example, when price moves from maybe here to here, the flow, the pattern that price used to approach this level to this level is what market structure is. When price moves from here to here, the pattern price used to approach this level to this level is what market structure is. Now, when it comes to the basics of market structure, we have three ways that price makes its movement. So firstly, we have what under the trending market, because it's two categories, the trending market and then the ranging market. But it's all three ways that price makes its movements. Now, the first way under the trending market is we have the uptrend. So basically, your uptrend is consists of when market is making a series of higher highs and then higher lows. So this is an uptrend when price is making a series of what higher. This is not in the advanced class. I'm just trying to get you guys up like on par with basic market structure before I now go deeper. So the uptrend consists of market giving you a series of higher highs and then higher lows, higher highs and then higher lows, higher highs and then higher lows. This is what an uptrend is, and is one of the basics of market structure, one of the ways that price makes its movement. So either price is trending to the upside, or is trending to the downside, or is ranging. An example of an uptrend is clearly this. You can see it. Market is giving you higher highs, it's giving you higher lows. It's giving you higher highs, it's giving you higher lows. It's giving you higher highs, it's giving you higher lows. It's giving you, so each high that comes out will always precede the other one. Then each low that comes out will always be higher than the previous low. That is how you can tell what an uptrend is. And in a downtrend, is market literally giving you a series of what? Lower highs, then lower lows. 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 Everything we have to trade about market structure all revolves around trading the patterns that price makes its movement. Everything you have to trade about market structure all revolves around trends or range. So the ranging market part of it is basically when market is consolidating. If you see it, you wouldn't really know if market is trending to the upside or is trending to the downside. It's just going to be fixated at one point. So an example of a ranging market is basically price what moving from support to your resistance. From resistance, it comes down to support. From your support, it goes back to resistance. From resistance, it comes back to support. From support, it goes to resistance, resistance to support. So this is an example of what an uptrend, an example of what a downtrend, an example of what a ranging market. These are the three basic ways that price makes its movement. There's no how you will see market approach one level or another, and they are not either trending to the upside, trending to the downside, or ranging. You guys, hang on, I'm coming. Wait, give me a minute. Sorry, I'm back. I was mute. I had to take my dog out because he was barking. So can you guys hear me now? Okay. I had to mute for a minute. So, like I was saying, the basic patterns that price used to move around, either is trending to the upside, or is trending to the downside, or is ranging. You will not find any market movement that does not involve any of these three. If you check here, market moving to the upside is trending up. If it's going to the downside, it's trending down. If it's not moving, it's ranging. So these are the three basic ways that price makes its movement. Is stable. This will always be a constant. Either market is trending up, or is trending down, or is what is ranging. So that's why I have to first of all illustrate that before I go further into teaching. Now, when it comes to market structure, what do we actually look out for when it comes to market structure? We look out for two important key concepts: the concept of reversals and then the concept of what continuations. What do I mean by that? If market is trending to the upside and is giving you a series of higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, this sort of thing, eventually it gets to a point where you would want to actually trade this. You want to either join the uptrend, or you want to get into the market and you came out and you found out that market was what trending to the upside. The only two things that will be on your mind is, am I joining this trend? Am I joining this buy, or am I joining this sell? These are the two things that will be on your mind. Market is on an uptrend. you come on the trade on your chart, you see the chart and everything, the market is moving. The only two things that will be on your mind is what? Is the market going to continue this uptrend, or will it just stop and then change to a downtrend and start selling? This will be your only two questions. That's the only thing that is needed when it comes to trading market structure. Whether you are selling or then you are buying, it all matters because of market structure. So already we have three ways that price moves: uptrend, downtrend, then what? Ranging markets. Now, the two concepts we use in trading this is what? First of all, the first one is what? The concept of reversals, and the second one is the concept of continuations. So the concept of what? Reversals. And the second one, the concept of continuations. Now, what this means is that if market is on a particular trend, or you see a basic market structure movement, you're either looking to reverse the direction of the market, or you're looking to what? Join the direction of the market and continue the trend. Now, the concept of reversals only works on trending markets. You see this uptrend and then the downtrend, you can only use the concept of reversals there. Meanwhile, the concept of continuations works both on trending markets and ranging markets, because you can only reverse a trend. So if market is trending to the upside, you can actually reverse it to the downside. And the market is trending to the downside, you can actually also reverse it to the upside. But you cannot reverse a ranging market. So the concept of continuation is only applied towards, you can use the concept of reversals on only trending markets, but the concept of continuations you can use in ranging markets and then trending markets. So now comes down to this thing: what is actually the concept of reversals and what is the concept of continuations? The concept of reversals is called a market structure shift. Now get this down. A market structure shift is the concept of trading reversals and is the indication that the current trend that market is on is ending and the new trend is about to begin in the opposite direction. I will type it down. The concept of reversals is called the market structure shift, or an MSS. Is the indication that the current trend of the market is ending and the new trend is about to begin in the opposite direction. This is what market structure shift is. So the concept of reversals is what you call a market structure shift. So under this, so what's the concept of reversals? So let me make it bold. Small bold. So the concept of reversals is called the market structure shift. It's basically the indication that the current trend of the market is ending and the new trend is about to begin in the opposite direction. One thing about the concept of reversals is that before markets can change from one particular trend that is on to the opposite direction, you must see a market structure shift. If you had market and it's been very bearish for a long period of time, before market to start buying back up, you must see the concept of reversal. And the concept of reversals is what? The market structure shift. Now, how do you now tell what a market structure shift is? So it's basically when price deviates from the current pattern of a particular trend. Now, we already know that an uptrend is made up of what? Higher highs and higher lows. The moment price deviates from making higher highs and higher lows, then a market structure shift just occurred. What I mean by that is an uptrend is what? Higher highs, higher lows. Higher highs, higher lows. Higher highs, higher lows. Higher highs. And when price comes here and fails to make a new higher low, so market can start pushing up to the upside again and it takes out this low, this is what you call a market structure shift. Same thing, a downtrend is made up of what? Lower highs, lower lows. Lower highs, lower lows. Lower highs, lower lows. Lower highs, lower lows. The moment price comes and then instead of making a new lower high to continue pushing market to the downside, it takes out this high instead. The moment this happens, then this is just what a market structure shift is. So a market structure shift is what? The concept of trading reversals. And before you can get market changing directions to any other side, you must first of all see a market structure shift. Not only a market structure shift, you must still see the other confluences that you need to take a trade for your reversal concept. But the first important thing you must see is a market structure shift. An example of that is what? This is a downtrend. Because how is it a downtrend? Market was giving us lower highs and then lower lows. Lower highs and then lower lows. Lower highs and then lower lows. Then what the price do came here instead of making another lower high so you can continue pushing back to take this low. What they do instead, it came here and took out this high and then closed above it with the body of the candle. The moment that happened, you got our market structure shift right here. So the market structure shift is basically a deviation from the current pattern of a particular trend. So even if it's just a mini trend for a small period of time, the moment you get that deviation from that behavioral pattern of that trend, then you've gotten a market structure shift. So this is an example of a structure shift. This was a downtrend and it consists of what? Lower highs and lower lows. The moment price disrespected that lower highs and lower lows and made this higher high instead, and they made this higher high instead, then you got yourself a market structure shift. Are you guys following me up? You guys should disregard the questions for now. You understand? Questions will come in later. Just focus on what I'm teaching for now. So disregard the questions for now. So the concept of trading reversals is what you call a market structure shift. So wherever you see a market or on any direction, maybe it's trending to the downside. Before that market will reverse from being on a downtrend to now being on an uptrend. Before that thing will happen, you must first of all see a market structure shift. And if you have market on an uptrend, before market will change direction from that uptrend to a downtrend, you must also first of all see a market structure shift. So, but there are other things that you that will be applied to this, and directional bias is one of them, which is why I say you just have to back test now and leave trying to enter the live market for now, because knowing just market structure and knowing just market structure shifts or the inducement and your point of interest is not enough. You can still also be trading in the wrong direction of the market and you will see all those confluences and still end up losing. That's why I would solely suggest back testing, and then if you want to forward test, take it on a practice account and then you understand, keep practicing until we are done with classes. That's when you can fully get everything you need to trade this thing well. So, like I said, market structure sheet is what? The concept of trading reversals. And then whenever you get that market structure, it means that whichever trend that market is currently on is about to end. And the market is about to begin a new trend in the opposite direction. So, and I gave an example of it here. This previous downtrend, then all of a sudden price took this high out, giving us what? A market structure shift. The moment that happened, it means that this downtrend that market was on before is now ending. And what market will do soon is what? To change directions to the opposite side, which is now, this thing was bearish before. The moment we got this market structure shift, and it's very clear, market is about to change directions towards to the upside. It's now going to disregard this previous downtrend and it wants to now become bullish. That is the concept of trading reversals. That is what the concept of trading. Just because you've been taught this does not mean, oh, that's what you're going to. No, it does not really work all the time. because you have to be trading in the right direction of the market. Market cannot be overall bullish and you'll be looking for trades to the downside and be looking at every sort of shift and say you are using it as just you will lose. Woefully, you will lose. That's why I would suggest waiting first. Another thing, another sort of shift here is again, what do you see? This clear uptrend is what giving us lower highs and lower lows, lower highs and lower lows. The last low was here. Price pushed up, and what did do? Came back again and broke this low. The moment this happened, it signified what? A market structure shifts. The moment this low was taken out. So market structure occurrence is what? When price deviates from the current pattern of the market. How is this a deviation? Because for an uptrend to be continued, market needs to be making lower highs and lower lows. But the moment that price what made after making this lower low here and made this lower high, it could not continue to keep making another lower high. Instead, it started going to the downside. That is what you call a market structure shift. So that low that price broke while trying to make that lower low, that is where your market structure shift occurrence happened. So that is the first concept of market structure, the concept of reversals. Now we're going to move on to the concept. Hope you guys understand what I'm saying, right? You guys understand what I'm saying? Can you guys hear me? Can you all hear me? Can't you guys hear me? No one is typing in the comment section. Okay. So I'll go again. The concept of reversals is what you call a market structure shift. It means that before markets can start changing directions to the opposite side, you must first of all confirm a reversal concept. What do I mean by that? Look, let's see. Market was moving up here last week. So we can see market giving us higher highs and higher lows, higher highs and then higher lows, higher highs and then lows. What the market do again? It came up here and took out this low. The moment this low was taken out, we got what you call a market structure shift. So it means that before market can change direction to the opposite side, now what happened after this market structure shift? Price eventually came up and then market started selling. So before you can see market change directions to the opposite side, you must first of all get the concept of reversals. That concept of reversals is what signifies that market is about to change direction to the opposite side. Same thing that happened here, this uptrend. But what the price do, eventually it came and took this low out. Instead of continuing making higher highs and higher lows, it failed to make a new higher low to push up again. What did it do instead? It took out this low. That signified a market structure shift. The moment you get a market structure shift, just know that market is about to change directions to the opposite side. So since this was previously bullish, the moment we got a market structure shift occurrence, it means our market was now preparing to become what? Bearish. And what happened later in the market? Price started dropping and selling. From this previous uptrend to now market becoming bearish. So the concept of reversals means that if market is on a particular trend, let's say market has been buying for a long period of time, before market will stop buying and start selling, you must first of all see a market structure shift. And if market has been bearish for a long period of time, selling for a long period of time, even selling for a short period of time, before market will stop selling and start buying, you must also see a market structure shift occurrence. That is what signifies a change in direction of the market. That is what you call a market structure shift. So that is what I was trying to explain to you guys. So market structure shift is basically what is basically the indication that the current trend that price is on is ending and the new trend is about to begin in the opposite direction. I've explained market structure shift again. Hope you guys understand me now. I don't know. Are you guys experiencing a delay? Is there a delay in this thing? Okay, good. Good. So that is what market associates is. Now that we are done with the concept of reversals, we can now move on to the what? To the concept of continuations. Now, what do I mean by the concept of continuations? When someone says you should continue something, it means that the previous thing you were doing before, they would want you to still stick to that thing. That is what continuation means. It means like proceed with the previous thing you were doing before. So the concept of continuation basically means for market to still maintain its current trend. And we use that concept of continuation when we want to join the current trend of the market. Let's assume that market has been selling from this zone down to this zone. It kept selling. Before market will buy, you will first of all see the concept of reversals first. After you've seen this concept of reversals, a market is now buying. If you want to now get more entries and join the buy, you will now have to use the concept of continuations for that. The first time reversal for the market from one direction to the other, you will get the concept of reversals. But the moment that price wants to now continue moving in one direction and you're looking to get more entries in that direction, you will now have to use the concept of continuations. So, for example, this sell that price was on, before price started buying, you will use the concept of reversals to get the first entry. But after you've used that concept of reversals, if you want to now get more entries for the buy moving forward, you now have to use the concept of continuations. I'll go again. If market was in one direction and you want to change the direction to the opposite side, you will have to use the concept of continuations. But the moment that you've gotten that so you have to, sorry, let me repeat myself again. If market is on a particular trend and you want to change the direction from that trend to the opposite side, you have to use the concept of reversals. But the moment you use that concept of reversals and you now want to now start trading in that new direction of the market, you now have to start using the concept of continuations. You're no longer reversing the market, you're now looking for continuations to now join in the current trend. If market is selling and you want to look for more sell entries, you have to use the concept of continuations. If market is buying and you want to look for more buy entries, you have to use the concept of continuations. But if market is selling and you want to look for buys, you have to use the concept of reversals. Same way, if market is buying and you want to look for sells, you have to also use the concept of reversals. I hope you guys are following me up. Is there a delay in my screen? But I was not actually drawing anything on my screen now. That's why I was not drawing anything on the screen. So there was no delay. I was not drawing anything on the screen yet. I was not drawing anything on the screen. So it was just on trading view. I was not drawing anything on the screen. Like I was not drawing anything on the screen now. I was just talking. Okay. So it's just like, hey, so let me explain it like layman terms. If you're moving from let's say Abuja to Lagos, you've been going from Abuja on a straight way, and you say you want to turn from Abuja and go back to Lagos. Sorry, let me just put it in a layway. You're going from Abuja to Lagos and you're moving in a straight line, and all of a sudden, halfway to Lagos, you say no, you want to turn back to where you're coming from. You have to use the concept of what? Reversals to reverse from where you are going to another direction. But if you are moving forward and you want to still find more ways to move forward, you now have to use continuations. That is basically what this means. If you are going down and you want to look for more entries to go down, you use continuations. But if you are going down and you want to start going up, you use reversals. Same way, if you are going up and you want to look for more entries to go up, you use continuations. But if you are going up and you want to go down, you have to use reversals. That is basically what this means. So that is just what I was trying to explain since. So the concept of reversals is to change the current direction of the market, but the concept of continuations is to join the current direction of the market. So this will narrow everything down for you, knowing when to use reversal concept and knowing when to use continuation concept. So after we've gotten our structure part of our strategy, our structure part of our strategy just consists of two things: concept of reversals and then concept of continuations. And now that I've explained it, we now know when to use which. But now I've not said what the concept of continuation is. The concept of continuation is called a break of structure. A break of structure is defined as when market keeps breaking a key level while maintaining its current trend. I'll type it out. A concept of continuations is what's called a break of structure. Sorry. It's called a break of structure. It's defined as a scenario where price keeps breaking key levels while maintaining its current trend. So the concept of continuations is called what? A break of structure, and is defined as the scenario where price keeps breaking key levels while maintaining its current trend. Breaking key levels means something like this. A key level can be a resistance level, a support level, a high or a low. You see this thing here that you just saw, market giving us higher highs and higher lows. The moment that price breaks this high is a key level. So this right here that just happened here is the break of structure. The moment price also breaks this high is also a key level. So this thing that just happened here is also what? Another break of structure. The moment price breaks this high is also a key level. So this thing that just happened here is what? Another break of structure. If it's for the bearish side, the moment price breaks this low is a key level. So this thing that just happened here is a break of structure. Then the moment price pulled up again and broke this low right here is also what? Another key level. So this is also what? Another break of structure. The moment price also broke this low is also what? A key level. So this thing that just happened there is what? Another break of structure. You see this range right here? This high and the low here is also what? Key levels. So if market keeps ranging and all of a sudden comes here and breaks and closes above this zone, then this thing just did here is also what? Another break of structure. That's why I said you can apply the concept on reversals, that is market structure shift, in trending markets, but you cannot apply it in ranging markets. But the concept of continuations you can apply in both trending markets and then ranging markets. So if market takes out this high, is a break of structure. All these lows that market is breaking while forming these lower highs and lower lows. You see these lower highs, lower lows. If you make these lower highs and makes a lower low, this low is a break of structure. A structure can be a support level, a resistance level, a low, or a high. So the moment price breaks any level, that's what a break of structure. So that is the concept of trading continuations. But when it comes to picking, for example, an example of that is, you see the moment that price did this stuff and then lower highs and then lower lows. This is a break of structure. When it breaks this high, it's a break of structure. If price breaks this high, this is also what? Another break of structure. The moment price broke this high, is also what? Another break of structure. So a break of structure is where market keeps breaking key levels, but it's going to keep maintaining its current trend. If you pay attention, while it was breaking this high and this high, it kept maintaining what? An uptrend. So that is what a break of structure is, where market keeps breaking a key level while maintaining its current trend. You see what this market did here? Taking this low out, that's a break of structure. It took this low out here, that's another break of structure. It took this low out here, another break of structure. All this is happening while market is maintaining a downtrend. That is what a break of structure is, where market keeps breaking key levels while maintaining its current trend. That is what a break of structure is. Hope you guys are following me up, please. So if your network is actually is lagging or anything, the class is going to be recorded. So even if you don't get everything in the first class, you can get it on the second class. Do you understand? So that is why I record the classes. And then there's question sessions for tomorrow, where if you're confused, you can bring the questions to the classes when we'll have tomorrow. So don't be in a hurry. I'm going to send the recording once I'm done with this class. Do you understand? We're in Nigeria now, so network sometimes fluctuates. So that is what a break of structure is. Now, the thing is that when it comes to trading break of structures, I don't I don't trade like every break of structure out there. That's what I pay attention to when it comes to trading break of structure. When it comes to trading the concept of continuations, that is what I pay attention to. And that thing is called double break of structure or multiple break of structures. What do I mean by multiple break of structures? When market is on a particular trend and is giving all these higher highs and higher lows, each high that market breaks is called a single break of structure. A single break of structure is basically when market takes out just one zone, just one level. It can be one resistance, it can be one high, but it's just taking out one level. But when I'm talking about a double break of structure or multiple break of structures, is where market takes out more than one zone. Now, what you ask me, what do I mean by more than one zone? Let's assume that when market was coming down, let's say there was a high here. Uh-huh. Then price was started, let's say market started moving to the upside and then gave us the structure sheet first and then eventually started buying. The moment price starts maintaining an uptrend and is giving you see this is a higher high and this is a higher low. This is what a single break of structure. It will give you what? Another higher high. Take out this high, another single break of structure. You pull back again, a higher high, another single break of structure. Why am I calling this single break of structure? Because it's just taking out one zone. One high taking, one high taking, one high taking. But see, the moment that price does this higher lows and then makes a higher high, taking out this high, and then this formal existing high here, that is what I call is a double break of structure or multiple break of structures. Because it did not only take out this zone, it also took out this zone. So this double break of structure is what I pay attention to when it comes to trading the continuation part of this strategy. But if it's for the reversal part, once I see any single market structure shift, whether it's a double or a single, I don't care. I've marked it out. But when it comes to trading continuations, I would want to see markets take out more than one zone. For example, the moment this high was taken out, I did not pay attention to looking for any trades here. You see, when this high here was taken out, I did not try to trade anything here. Why? Because only one zone was taken out, and that is what you call a single break of structure. But when this high was taken out, I paid attention to this zone. Why? Because when market took out this high, it also took out this high that was existing here before. And it also even took out this high that was also existing here. Market needs to close above those zones. So the moment price took out this high, and this high, and closed above it with the body of the candle, I can call this a double break of structure, and I can focus on looking for entries for this zone. But you see this single one that just took out one zone, I'm not looking for any entries here. I don't pay attention to them. I will just disregard it. But you see this one that took out this high right here, and then this one. Even if it just took out this high and this high, as long as it took out more than one zones, I can look at this as a double break of structure and be able to use that for my continuation entries. Same thing here. Remember, I said continuation and break of structure, or more especially double break of structure, is only used in trading continuations. It means that it's only when market is already moving in one direction and you are looking to enter a trade in that same direction, that is when you now use double break of structures. So for example, market was now already moving to the upside. If I missed the market shift entry and I want to find an entry for this uptrend, I will use double break of structure. And exactly when did I get my double break of structure? The moment price took what this high out and also took out this high that was existing here previously and closed above that zone with the body of a candle. That is what you call a double break of structure. So this is, I can pay attention and trade this one for the concept of continuations, but I will not trade this one because only one high zone was taken out. I will trade this one because this zone and this zone was taken out, so more than one zone was taken out on the market. So that is what I call a double break. So when it comes to trading reversals, I can use a single market structure sheet. If market structure sheet just took out one zone, I will trade it. But when it comes to trading continuations, I would want market to take out more than one zone when it's breaking a structure. Hope you guys are following me up, please. Okay. So a lot of people tend to a lot of people tend to like misinterpret this, and a lot of people tend to not know when they should be expecting to get continuation entries from. It's confusing to some people. You understand? It's confusing to some people, and it should not be. So you need to narrow down everything you are trading, knowing that if I have markets selling for an extensive period of time, let's say any pair you have that have been selling for a long period of time, before that pair can be used as this thing, before you can use that pair and reverse the trend of the market, you must first of all see a market structure shift. But if market is what is, let's say, selling, and you know you strongly just want to look for sales, all you need to look for is what? A double break of structure. That is all you need to look for. So that is the concept of reversals and then the concept of what? Continuations. So as market is already selling here, if I was to look for more entries for a sell, what I would wait for is for market to take out more than one zone. So you see the moment that price took out this low, see this low here, and also took out what? This low. This is what you call a double break of structure. From this, I can actually wait for market to now give me a continuation. And what the price after that, it kind of made the retracement back for you to now get a good confirmation to sell again. I will move on to point of interest later. But I'm trying to tell you where I would actually start looking for entries for a sell. Normally, the market was already bearish, it's already selling. If I should want to look for more entries for this sell, what I will look for is a double break of structure. I wouldn't look for anything here because only one zone was taken out. I wouldn't look for anything here because only one zone was taken out. But the moment price took this low and then this low and closed below them, I will start looking for entries around this zone because it's a double break of structure. So that's the mistake that most people make. They don't actually look out for double break of structures or this thing or yeah, they don't look out for double break of structures. They just look out for, and they don't even know how to trade continuation. So that's most people mistakes that people make. So double break of structures is used to trade continuations, while market structure sheet is used to trade reversals. So just get that in your head. If market is on any direction, before it will start reversing, you must first of all see a market structure shift. But if market is in any direction and you want to still trade in that direction, look for double break of structures. So that is that for the structure part of this strategy. So after the structure part of the strategy, what comes next is now the liquidity part of the strategy. After the structure part of a strategy, what comes next is the liquidity part of the strategy. Now, what is liquidity? Liquidity are zones in the market where there are like money. You understand? The zones where there are money. Because liquid, I don't know if you know what liquid means. If you're talking about finance, you're talking about liquid. It means like you have like money, like liquid cash. So liquidity is basically a zone where there are a lot of money in the market. Now, there are different types of liquidity, a lot of them. But there's only one type of liquidity that I pay attention to when it comes to picking the for entries for my trade. When it comes to picking entries, hello, is everything? Am I? Can you guys hear me? I feel like my network disconnect. Can you guys hear me? Can you guys see? I had to switch network. I don't know if this one is better. I had to switch network. Sorry. The other one was I had to switch my network on my right router. Is this one better? I don't know if it's better. Tell me so if I will know if I can switch to the other one. But like, I don't know the whole network. And then the worst part is I'm using router. Like I'm literally using router. I'm using router. I don't just understand. Let me first of all load TradingView. If TradingView loads well, then I will know that this one is better. If it does not, then I'll have to switch the network back. I think the I don't know if this current network is better, but let me just continue to see and then I will see. You guys will tell me if it's better or not. Let me share my screen with you. I had to switch router. Now let me go. So is this one better? Is is this one better? I'm moving the trading view around. So you just comments, I'll read it and know if this one is better. The former one was better. Now let me use this one. Even if the thing lags, I don't think the recording is going to lag. So, but if you ask me, I feel like the former one is better. Exactly. Hang on, let me switch to the former one. Let me switch to the former one. Let me switch to the former one. I'm coming. Let me switch to I feel like the former one is better. I don't know. I'm using a router. Like literally, I'm using a router. And it does not really affect every other thing. It's only when I try to host on Zoom that this starts happening. So let me just try the former one again. Come on. Mhm. Okay, so I'm back. I'm back to the former one. Guys, tell me, is it better now? I'm back to the former network. Is it better now? Uh-huh. Okay. Good. Okay, yeah, this is faster. So this, what I just thought is the structure part of the strategy. Now it's time to move on to the liquidity part of the strategy. And like I said, there are different types of liquidity that we have. But for this particular session, for this particular class, this first session, I'm going to be talking about only one type of liquidity, and is the one we use in picking entries, and is called inducement. Now, inducement is a type of liquidity that we use in picking our entries. An inducement is what? The first valid pullback that price gives you after a market structure shift or a double break of structure. Listen again. An inducement is the first valid pullback that price gives you after a market structure shift or a double break of structure. Let me type it out. An inducement. So, what I mean by a pullback is kind of like a retracement. It can be market giving you a slight retracement into where your market structure shifts came from, or into where your double break of structure came from. Like an example of that is, let's say you have this uptrend, then we got our market structure shift. After that, price should give you a retracement to the upside before eventually continuing pushing back to the downside to either take this low out or get close to or equal to this low right here. The retracement, this candle retracement, is now what your pullback is, and that is what your inducement is. Same way, after this market structure shift, price should what? Pull back to the downside before eventually pushing back up again to either take out this high, or it will just slightly close above the high or be equal to the high. But it should at least get close to the high or take it out. That's what makes a valid inducement. So the low right here is what your inducement is. If it's a scenario of a double break of structure, I remember when we're looking for inducement, we're only looking for it after a market structure shift or after we get a double break of structure, not before a market structure shift and not before a double break of structure. You see these single break of structures, I'm not looking for any inducement from these ones. The ones I will look for an inducement in is the one that comes after a double break of structure. So the moment that price takes this high and this high out, that's a double break of structure. So I would expect a pullback to the downside before price will continue pushing to the upside again to either take this high out or come close to or equal to this high. This would be my inducement. So on this example here, when market gave us a structure shift to the upside and then price stopped, this was where the close happened. The moment price pulled back down before eventually pushing back up to now take this high out, then this low is our inducement. Understand? Same thing. It can be a single candle, provided that that single candle continues moving in the direction of where your structure shift candle stopped or the break of structure candle stopped. Is valid. For example, when market took this high and this high out, this is a double break of structure, and the high for that double break of structure ended here. The moment that price gave us a retracement, this is a retracement. See this candle wick here is a retracement. This is an inducement. The moment that price gave us this retracement before pushing up again to take out this high, then this is an inducement. Same thing here. The moment price came here, took this high out, and also taking out this high, a double break of structure. The moment price did that and the candle closed, and then price came back again to now give us this pullback before price pushed up again to come here to take out this high, then this is a valid inducement. So this is an inducement. I will mark it with IDM. This is an inducement. I will mark it with IDM. So in some cases, you will see the inducement very clear, like it will be a full candle. And in some cases, it will just be a small candle wick. It all depends on the volatility of the market at that given moment. So this is an inducement. I'll mark it out with IDM. And then here also, after this market structure shift and price put down to the downside, give us that retracement before pushing back up. This low is our inducement. I'm working with IDM. So an inducement is being gotten after a market structure shifts or what? A double break of structure. That's what an inducement is. So that first pullback that price will give you after a market structure shift or a double break of structure, that inducement, that pullback is what your inducement is in the market. That pullback is what your inducement is in the market. So there's something I was looking for before. See if I can spot it. Okay. Another example of this is market was on a downtrend for an extensive period of time. So this is a question to you guys. Now, before I will start looking for buys on this downtrend, what concept of market structure do I need to see first? Market was bearish, it was selling, giving us lower highs and lower lows and lower high. So before I will start looking for buys in this downtrend, what concept of market structure do I need to see first? The question is for you guys to answer. Exactly. See, you guys are catching on. So before I can start looking for buys in that downtrend, I need to see the concept of reversals. And the concept of reversals is called what? A market structure shift. And how do you get a market structure shift? The moment price deviates from the current pattern of the particular trend is on. So it was on a downtrend, and the current pattern of a downtrend is what? Lower highs and lower lows. So the moment price deviates from making lower highs and lower lows, then it means that I've gotten that reversal concept. So let's see if we can spot market deviating from that current pattern. So let's see. We're seeing lower highs and lower lows and lower highs and lower lows and lower highs and lower lows and so on. So the moment that price came here, after making this last low, and then it came up, instead of making another lower high, so you can continue pushing to the downside, what did it do? It came up here and took out this high. The moment that happened, we got what? A market structure shift. You can even say, even if this is not the high you saw, when this high also was taken out, it is still a market structure shift. So when price took out the high and closed above the high with a body candle, then that is what a market structure shift is. So this high was taken out, but I saw my structure shift here. It's clearer here because this was the last high before market made this low and the high was taken out. So yeah, Eddie, if you pick this up, it's still a structure shift. Hang on, I'm coming. So on this chart now, yeah, we have seen our concept of reversals, which is what our market structure shifts. So remember, is market structure, liquidity, point of interest. So if you've seen the structure part, you now have to move on to the liquidity part, which is what? The inducement. So remember, our inducement is what? The first pullback that market gives us after a market structure shift or a double break of structure. And when market gave us this market structure shift, the candle stopped here. This was the candle of that structure shift, the high. This is the candle, the high. So after that, market came back down and gave us a pullback, kind of a retracement here. This candle right here, this wick, is what our inducement is. I'm trying to be very precise here. A newbie that's still coming into here would have marked this as their inducement, no problem. But that will really, if on the long run, it will mess up where you are picking your entries. So you have to be very precise at where the structure shift came, and then marking out the retracement that comes after to be able to mark your inducement properly. So this is the inducement here, the pullback the market will give you. Our inducement. Our market will ITM. So you see, that is this thing. So and then this is the reversal on. Now that market we already got that concept of reversals, and if you're now looking for more entries for a buy, now that we already gotten that market is now bullish after we got our structure shift, and we're looking for more entries for a buy, what are we now going to be looking for? The concept of what are we going to be looking for? If we've already gotten that concept of reversals, and the market is about to start buying, and we're now looking for more entries for a buy, what concept are we looking for? Exactly. So you guys are following me up. We're now looking for the concept of continuations, and in this scenario, a double break of structure. Now, a double break of structure where market takes out more than one zone. So when markets came here, gave us this higher highs and higher low. Was there a double break of structure here? No, because there was no two zone was taken out. But the moment that price came here and took this high and then this high out. Now, is there a double break of structure here or not? Exactly. That's a double break of structure there. So if we're looking for where we'll be looking for entries, we can actually mark and pay attention here. Do you understand? So after we've gotten the double break of structure, next thing we'll look out for is what? The liquidity part of the strategy. Remember, for structure part of our strategy, we're looking for two things: market structure shifts, double break of structure. Any one of them that we'll see, we'll take and move on to the next. In this one, we saw a market structure shift. We took it and we moved on to the next, which will be the inducement. In this one, we're looking for continuation, so we'll look for double break of structure. So when this high here and then this high was taken out, we got what? Our double break of structure. So we have gotten the first one, that is DBOS. In fact, this high here was also even taken out. So the DBOS even came from this zone. So it took this zone, this high, and this high, multiple zones. Now the next part is for us to look for our what? Our liquidity. And the liquidity is what? The inducement. The candle for that double break of structure closed above this zone. This was where the candle stopped. So we would expect price to give us a retracement to the downside before pushing up to take out that high of where that double break of structure candle ended. So the moment that price pulled back down, gave us this low before pushing up to take out this high, we got our inducement. That is our IDM inducement. Now, the inducement is a trap. Price will always come to sweep inducement and take it out. Wherever you mark inducement, don't rush to enter the market at that level. Markets will always come out to take your inducement away. Markets will always come and sweep your inducement. That is why it's liquidity. That is why it's a trap. So it's just for you to mark it out and wait patiently for price to eventually come and take it out. Now that is when we now move on to our point of interest part of the strategy. The point of interest part of the strategy, we have 2 points of interest that I make use of: order blocks and breaker blocks. In this class, I'm going to talk about only the order block, and in the next class, we'll now move to the breaker block, because there are times that price will trigger from the order block, and there are times that price will trigger from the breaker block. And there are rules in picking a point of interest that will tell you whether you're picking your entry from your OB or from your BB, which is your breaker block. So, but in this class, I'm talking about the order block, and most of the examples I will give are with order blocks. Anyone that does not correlate with our entry, just know that the entry is supposed to be with a breaker. So on the next class, I'll talk about the breaker, talk about the rules in picking a point of interest and all that. But for this class, I'm just introducing you guys to the concept and the strategy. So you have to bear with me. So now that you've gotten your structure part of your strategy, your liquidity part of your strategy, which is your inducement, it's now time for the point of interest. So the points of interest I make use of the OB and the BB. Now for the other block, that's what I'm going to talk about in this class. Now the other block is a zone in the market where there are a lot of institutional orders. What do I mean by institutional orders? You see the buy and sell limit orders of banks, the big institutions and all. the zones where they place their buy and sell limit orders, that's what your order block is. So we have two different types of order blocks. We have the bullish order block, and then we have the bearish order block. The bullish order block, you can identify it by what? Seeing a bearish candle, then seeing a bullish candle that engulfs it and covers it up. This is the bullish order block. And then the bearish order block, you can identify it by what? Seeing a bullish candle, and seeing a bearish candle that engulfs it. So if it's a bullish order block, you first of all see a bearish candle, then you now see a bullish candle come up and engulf it. But if it's a bearish order block, you will see what? A bullish candle, then a bearish one that engulfs and covers it. And if you're picking your entries, you pick your entries from the demarcation of those candles. The demarcation of this candle here. That's where you pick your entry. And your stop loss are the last candles of those candles. So if you're picking your entry from here, your stop loss will be below here. And if you're picking your entry from here, your stop loss will be above here. So there are sometimes you also find wicks in your order block. For example, you can see a candle wick here in your order block, and you'll be confused on where to pick your entry. If the wick is extremely small and smaller than the body of the other block, you can pick your entry from the wick of the other block so you don't miss your entry. But if it's an extremely long wick, for an example, this is the wick here and it's extremely long. If you want to pick your entry, you pick your entry from the body of the other block, especially if the wick is longer than the body of the other block. Pick your entry from the body here. So it's now time to fuse everything together. So first of all, this was the previous downtrend before market gave us a structure shift. After giving us the structure shift, we have gotten the first part of our strategy, which is what? The structure part of the strategy. Next thing is to now look for the liquidity part of the strategy, which will now be your inducement. And the moment that price gave us this pullback before pushing back out to take out the high of whether market structure shift candle stopped, we got our proper inducement. Now, lastly, we're now going to look at our point of interest. And in this scenario, everything I taught you guys is about order blocks. So you now have to look for your order block candle. And since this was a previous downtrend and we got a market structure shift, which direction are we looking to trade this market in? If you have a downtrend and you get a market structure shift, which direction are you looking to trade? Up, to the upside. So we are looking to buy. Exactly. So we're looking to buy. So since we're looking to buy, we're going to be making use of the bullish order block. And the bullish order block is made up of what? First of all, a bearish candle, and next, a bullish candle that what? Engulfs it and covers it. So if you look for it here, where can we find it? It's literally here. This is the bearish candle and the bullish candle that engulfs it. And we're picking our entry from the demarcation of the candle here. So this is where you mark your entry and wait for it. And then what the price do, eventually price came up and rallied up and then swept our inducement and then triggered our order block here. Our stop loss at the last candles. Normally, the stop loss is supposed to put it here, but with experience, me trading this strategy, I already know where my stop loss should be with experience. So you can backtest how other blocks look and where to put your SL. But normally, this is where you're supposed to put your stop loss on this trade, but it's not supposed to put to this level. I took this trade and my stop loss was here. So with experience, you will get that. But normally, you would have kept your stop loss here. And this was the trade. So I'll teach about take profit levels later also. So this was the trade. So whenever one market came here and triggered this zone, immediately started buying. So my stop loss was here for this trade because I took the trade. And this was the particular trade. So confluencing structure, liquidity, point of interest, we're able to get this first trade. This is for reversals. Now let's assume you missed this trade. You are not on the chart when this happened, but you already know the market is bullish and is already buying. So you're looking for more entries. That then now comes continuations. So the moment that price came here and took this high out, and then this high, we got what? A double break of structure. After that, the next thing you look out for is your inducement. And remember, when market gives you a double break of structure, you are still going to be trading in line with the current direction of the market. So this market is bullish and we got a double break of structure, which direction am I supposed to still be trading this market in? Exactly, to the upside. So I got my double break of structure. The next thing I will look out for is my inducement, which is this pullback that price gave before pushing to the upside. That is my proper inducement. The next thing I'll now look out for is my point of interest. And since I'm bullish, I'll look for the bullish order block. So you see the bullish order block is what? You see the bearish candle, then the bullish candle that engulfs it. My entry will be from this order block here. So eventually, price will come out and sweep your inducement and then trigger your point of interest. Stop loss at the last candles of the OB. This was the second entry for the continuation. Okay, let's still assume, okay, you are not active. You still missed this one. You still missed this one. You want to still enter a trade again. No problem. Since we are still looking for more buy entries, continuation entries, the moment price came here, took this high also, and also took this high, we got our multiple breakout structures. After that, price came here and gave us an inducement before pushing back up here again. So this is a proper pullback, our proper inducement. Now, this is where it gets confusing. You will now start marking your entries as this OB here, and price will not trigger you in. You will now think, oh, you are still waiting for this OB. It will never tap you in, like you have missed. Why? Because of this breaker block. This is where price bought from. Now, in the next class, we'll talk about the breaker, and we'll talk about the rules in picking a point of interest, why I picked my OB here, picked the OB here, and in this scenario, I'm picking a breaker block. Why? There are rules in picking a point of interest that will tell you whether to pick your entry from this or from that. But just know that one of the rules says you pick the point of interest that is closest to your inducement. But in the next class, we'll get deeper into it. I just want you to know that even if I missed this first buy, I would have gotten in from this continuation here. And even if I missed the continuation here, I would have still gotten in from this continuation here, from this, understand, the same double breakout structure inducement, and I would have gotten the continuation from there also. So it's the same thing over and over and over and over and over again. Here, this trade, markets gave us our market structure. This was a previous downtrend, and since this is a downtrend and we got a market structure to the upside, which direction are we meant to trade the market in now? Previous downtrend, market exactly to the upside, so we are looking for bullish bullish moves. So after we got this market structure, we now have to look for the next part of the strategy, which is now the liquidity, which is the inducement. So the moment that price gave this pullback to the downside before pushing back up to take out this high, we got our proper inducement right here. Lastly is the point of interest. Same thing, the other block. This is our OB. This is where the entry is. Pick our entry from the other block, this zone. And that was what exactly price did. Tap to the other block and then started buying. Just so you guys, I'm taking all these trades. I will go to my Telegram where I keep my private trades and I will show you the trade. Is this trade right here? Let me see, because it's been, yeah. This is the trade right here. I missed the main entry, but I got in at this level. And this was when market was moving. I still got the continuation entry again, and then I still hit it. Now, this continuation entry, I'll still show you the continuation entry with this double breakout structure because that was how I was able to get the continuation entry. Now, market what came here after the main entry has been triggered. I looked for another entry again. When market took this high out, remember, continuation double breakout structure needs to take out more than one zone while maintaining its current trend. So it took out this high and then this high. I got my double breakout structure, and I'm still looking for bullish moves. After that, market give me a pullback before pushing back out to the upside. That is my inducement. Lastly, my point of interest, the other block. This was the second entry for the continuation here. So just put everything I'm teaching is literally how the market moves. Is the structure, is everything. This was the second entry right here. And that's the entry here. See, so this is the first one, mood. Second one, mood. So that was literally the trade. So they trade him. You can see the BTC buy, BTC buy. I end up making 40K that day. So that was the BTC buy from down here, like the trades I took for this thing. So it's literally the same thing, same concept over and over and over. We will get more examples when we talk about the other point of interest in the next class. And then so because most of the examples now, because once you get a reversal, the most of the things we are focused on now is trading continuation. In fact, as the market has been buying to the upside here, we're no longer using double breakout structures. We're looking for continuations, and most continuations work well with breaker blocks. So when we talk about breaker blocks, we can talk about the rules in picking a point of interest properly, and then we'll get more examples. It becomes more elaborate to you guys also. So hope you guys followed up what I thought. So the thing is, so we still have the second class that we're going to do tomorrow because it's class are supposed to be Sundays, but I fixed it today because I lost my aunt this week. I lost my dad's sister on Tuesday, I think, or on Sunday. I've forgotten the day, but either Monday or Tuesday. I was told late, so I had to come back from where I was to the east. So that's why the schedule was messed up. So I had the first class tomorrow. We'll have the second class, but on the long run is Sundays. Tomorrow for the questions. After you watch the recording and understand this thing, we'll now bring the questions and I'll answer for the question sessions in the class. So we'll also talk about the other points of interest and the rules in picking a point of interest. We'll talk about the different types of liquidity that we have in the market. We'll now talk about the directional bias, how to get the right bias overall. That will be in the final class. So that is it for this session. Tomorrow we'll have the second class, the same time, 8 p.m. Do you understand? 8 p.m. So that's it for this particular session. Once the recording is done, I will send it to you guys. Once the recording is done, I will send it to you guys. Someone is saying recap. You don't need a recap. The class is recorded. You can just watch the class and back test and forward test what I just taught. I think it will be BTC because my market is closed currently. I'll open the group. I want to open the group towards the end of the session because if I open the group, now a lot of people will DM me to close it because you guys will start missing important updates that I will drop in the group. So that is it for this session. Tomorrow we'll have another class, and then the questions you have for this class you bring it tomorrow. So I hope you guys enjoy the rest of your night and good night.